From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Super Bowl weekend, February 7th, 2025. We have a truckload of strangeness this week, but first let's check the calendar. Your Milwaukee Bucks are at home for a few games this week. The Sixers are here on Sunday, the Warriors on Monday, Minnesota on Wednesday, and the Clippers on Friday. The Admirals are home tonight and Saturday at the Panther Arena. And what should be a spectacular evening, the Milwaukee Symphony is performing Pink Floyd's Dark Side of the Moon tonight. All right, let's get to the silliness. That means we should start in Florida. A Florida man in a Dalmatian onesie, you heard that right, a Dalmatian onesie, outran troopers, tasers, and dogs, and since he wasn't caught, we know nothing more about this dude except he's from Florida. And that speaks volumes. This one is also from Florida. A man told doctors he ate nothing but 6 to 9 pounds of butter, cheese, and hamburgers every day for 8 months. Surprise, surprise, he ended up in a Tampa General Hospital. Yellowish lumps of cholesterol oozed through his skin and onto his body. The instrument used to measure his cholesterol was a butter knife. Finally, officials say there's a bizarre accident at the Pittsburgh government building. A toilet exploded, leaving one man with a gash on his leg. And it could have been worse. He could have been sitting. On the podcast today, we have Art Rothschild, Mike Helzel, Joel Driesing, and wrapping up the week, here's Kyle Tenney.
Well, thanks, Max. A bit of a down week this week for stocks, although fairly calm. The NASDAQ down 0.5% on the week, down 104 points, closing at the bell at 19,523. The S&P down 0.2%, that's 15 points, closing Friday at 6,026. And the Dow Jones Industrial Average down 241 points after dropping 444 on Friday to finish the week down 0.5%. Closing at the bell on Friday in New York at 44,303 for the year. NASDAQ up 1.1% still, the S&P up 2.5%, and the Dow Jones Industrial Average up 4.2%. Mike, I think this is the week in which we kick off with you, just given the weekend's festivities. I would be remiss if I didn't mention, of course, the Super Bowl indicator, our fighting Kansas City Swifties versus our Philadelphia Fly High Eagles. I think historically we would have thought that potentially the Kansas City Chiefs, being the team that the Super Bowl indicator would indicate would be maybe bad for our portfolios. Of course, no actual rhyme or reason as to why that should be, but who you got?
I'm going to go with the EGLESS, Eagles. If you don't know what that is, look it up, folks. Someone actually spelled that in public. No, I'm going to go with the Eagles this week because why not?
And I think the Eagles being the pick that should bode well for our portfolios if the Super Bowl indicator holds something like 80% of the last 50, however, what are going on, Super Bowl 58 or 59 now, so the last 58 Super Bowls, the market performance following the Super Bowl followed that indicator. No real reason to think, again, there's any actual merit to
But it was a higher percentage success rate early on. After the first 3 or 4 Super Bowls.
Yeah, the indicator I think this year is if the Eagles win, we're in for a good year in the stock market. Again, folks, that is the EGLESS Eagles that I believe a county board member of Philadelphia spelled it that way at a team pep rally. But stay in school, kids.
Didn't the market go up the past 2 years like 25%, 26%, and didn't the
it's not
Kansas
science,
City
Arthur.
win?
It's just Super Bowl fun, man.
Well, and now you're hitting the nail on the head of where I think we need to go, Art, which is the fact that we're a year removed here from any kind of real market correction. We've seen massive stock runs going back quite some time, and despite the silliness of a Super Bowl indicator, despite the silliness of all the other pieces of the conversation that are out there right now, for no other reason than the passage of time, we're closer today to the next correction than we were yesterday. And so when we look at kind of what's been an okay start to the year, certainly a lot better than I think what we're probably entitled to given how strong last year was, but on the heels of what's been a strong economy, on the heels of what's been strong earnings, I think a reminder is in order that there's a lot that we still need to be paying attention to that might maybe cause us to continue to kind of view risk with open eyes.
Yeah, I think this is a great opportunity for what I, in my notes for this, session, called the gut check. We've done really well, as I mentioned a second ago, 26% on the S&P a couple of years ago, 25% last year. Haven't, as you just indicated, had a correction since the summer of 2024. Haven't had a bear market or a recession since 2022. And the stock market, we didn't even have a recession then. We had a sell-off in 22. We hadn't had a recession since 2020. So the market went down in 22 because investors anticipated a recession that never materialized. This economy couldn't be better. Our domestic economy is the best in the world. This week it seemed like so much happened, but nothing really did. We started the week with the threat of tariffs dissipating on Monday when Trump pulled back the suggestion he was going to tariff Mexico and Canada, our trading enemies, obviously. And but he didn't stop. He kind of put them off. And now Friday the market went down again after stabilizing because of his threats of doing an announcement next week about what's really going to happen. When all he has to do, quite frankly, to stabilize the markets is to suggest we're not going to do this for a while, meaning a long while. So I'm a little bit concerned. I've had clients call because they're a little bit concerned. People have done well the past couple of years. If there ever was the time to look at your portfolio and see how much more you have in the market than perhaps you had the last time we went off a cliff, it might be time to take stock of what you have, how well you've done, and how well you can do with less risk. As you've suggested before, bonds are a great place to put money if you want to earn 4 to 5%. Stocks, we're not going to say we think stocks are going to go lower because we don't know. We think stocks over time are going to go higher. Which kinds of stocks? It's interesting to see the Dow do significantly better than the NASDAQ this year, first time in a long time. So I think it's a great time again to call us if you have concerns. It's a great time to take stock again of how well you've done over the past couple of years. And don't let the news bother you, but if it does, please give us a call.
Kind of piggybacking off that, Art, one of the things I have been talking to my clients about is a lot of questions about the tariffs, because you are getting some conflicting information from the president and people in his administration, right? They say, all right, these are happening. Well, are they happening broad brush, or are we going to exempt some sectors, right? Again, the example I've been using in client meetings is we have a housing issue in this country. We import a lot of cement and lumber from Canada. Are they going to exempt those from tariffs because they know we need them, or are we going broad brush? Well, you'll see people within the administration say, nope, we're going to look at it sector by sector, and we'll go from there. And then 90 minutes later, the president comes out and says, nope, we're going across the board. So that provides some uncertainty. And you get, again, markets hate uncertainty. And so even though what I've kind of been doing for clients is, even though the market has started off well, we've been dialing back on stocks a little bit because they've done so well over the past 2+ years. It doesn't hurt to take some of those gains off the board, knowing you still have enough in stocks to participate in any upswing, but also with the uncertainty of tariffs, you're kind of threading the needle here. You're making your portfolios a little bit safer, but not going into some defensive, conservative type crouch that if the market does go up, you're going to miss out on anything.
I think, Mike, the pace of change in the first few weeks of this administration has been as fast as we've seen. That's not atypical of the start of any new administration, right? You come in, you're trying to get things done fairly quickly so that the policies that you were elected to enact have now some time to work towards their end goal. And so I'm not, I guess, surprised by pace so far, but to your point, it does add to the uncertainty. It does add to this need to know that, well, okay, we've got new things that are coming, new things we need to deal with. And what does that mean for my portfolio? It doesn't really change my long-term view. The economy's still on pretty solid ground. The earnings picture has materialized in a way that I think is pretty attractive for corporations going forward. When you dialed into some of the earnings calls from the big tech companies in the last couple of weeks, you heard tech companies that despite some fear last week that maybe the AI bubble was starting to burst, those companies aren't saying they're going to spend less money. They're saying they're going to spend more money on continuing to implement these changes, these technological innovations. And so, if anything, I think while there's plenty of uncertainty that to me means, yeah, let's keep that safe piece of our portfolio safer than we have, let's make sure that there's enough in it, it also tells me that, okay, but investors long-term thrive in that uncertainty, that it creates opportunities for gains that aren't otherwise there, because if you know what's coming, you know what you're supposed to pay for it. And so I think that's a reminder that we need if we're concerned about markets right now, if we're concerned about the economy. And Joel, we'll talk a little bit in a minute about why maybe we're overblowing some of the immediate risk, given that we've seen some data now that says, hey, things are okay, but also that there's some stuff out there that points to maybe we have some concerns about inflation, maybe we have some concerns about some other things that are out there, all part of this conversation we're having more broadly. But when I look at the opportunities that get created in that uncertainty, I think, okay, that's why I'm an investor, right? That's why I want to be positioned in stocks for the long run. And Joel, we kind of hinted at it, but we got an unemployment number this week that shows that, hey, maybe the hiring market, maybe the labor market isn't quite as strong as we assumed, but it's still far, far stronger than it was.
Employers added jobs in January for the 49th month in a row. Think about that, 4 years in a month. I mean, that's a long time. That's a consistent, strong economy. The Labor Department also, though, revised, as they do every year, they revised numbers from the past couple of years, and they saw that employers didn't add as many jobs as they thought in 2023 and the beginning of 2024. Still, it's strong, and it may be slowing down. The number of jobs added in January were 143,000. That's below the 166,000 for 2024. So it's, slower, but it's still going.
One of the things I always look at when I see that the hiring number, the creation number wasn't quite as strong as we thought, but that the unemployment rate still went down is, okay, well, how many fewer people were participating this month than last? And we didn't see that this month, right? It's been a pretty stable number now going on a couple of years after that big drop-off in the pandemic, people kind of leaving the workforce for a little bit. They came back in spades in 2022 and kind of the lead up to that. And now we've kind of settled back into a range that maybe it's not quite where it was pre-pandemic. But again, with an aging population, with a demographic shift that was taking some undercurrent to that broader conversation, well, okay, I'm pretty encouraged by the fact that we didn't see this massive, the reason the unemployment rate looks so great is because people just aren't looking for work anymore. There's still people out there looking for jobs at the same rates they were going back 6 months, going back a year.
Right. So the unemployment rate went down to 4% in January. That's the lowest it's been since May. But it's only been 4.1 or 4.2% in the months in between there, and that's historically still a low unemployment rate. And what you were referring to, the labor force participation rate, that was above 63% just going into the pandemic, and since that went way down, and now it's stabilized around 62.5%. So that's been pretty steady, but it's lower than it was, as you said, before the pandemic. And a lot of it, so that's measuring of the people who are eligible or who would be able to work. That's the percentage who are either working or looking for jobs, actively looking for jobs. So again, that's been pretty steady, and it's as you said, lower before. But that's also showing some wiggle room in case there is a stronger demand for workers, that there might be some more out there.
Yeah, and those people maybe not looking right now for whatever reason, they don't see the benefit to paying for childcare, and so they'd rather stay home with the kids. But if you want to pay them a little more, or if there's a job out there that attracts them, maybe they come back to the marketplace, or maybe there's a variety of other reasons why you might not be gung-ho about entering the workforce again, but that will change over time. And
those labor numbers are important, and economists watch them closely, because that's one of the factors that goes into consumer confidence. And, we keep talking about how consumer spending drives 71% of the gross domestic product. And if people have stable employment, if they feel like their jobs are a secure thing, they're going to keep spending money.
And of course, we had a consumer sentiment reading at the end of the week, and it maybe caused a little more concern for markets than what it might otherwise have. A decline in the way kind of consumers feel about what's coming.
Yeah, and a very unusual uptick in expectations for inflation, and part of that is because of uncertainty over tariffs. That also came up in the Institute for Supply Management had numbers this week on the service sector of the economy, and they interview supply managers across the service industry, and they also said that they had some concerns about tariffs, but it's that uncertainty that you talked about before.
Art, one of the things we look at is, where are interest rates headed when we talk about the fixed income side of our portfolio. And an obvious concern that, was highlighted in that consumer sentiment number is, well, what if tariffs cause some inflationary spike? The problem, of course, for the Federal Reserve is that I'm not sure raising rates has much of an impact on inflation caused by tariffs, that their tools aren't particularly well designed to deal with those issues, but it is the tool they have. And so we probably need to pay a little more close attention to what direction are rates headed with respect to that broader conversation on where a price is going.
Yeah, and the Fed is pretty much on record as suggesting they're going to hold rates steady. I think that's the expectation right now. They've noted their concerns about tariffs, causing higher inflation. One could envision consumers spending less because they're apprehensive about higher prices, or you could see them spending more in anticipation of the prices going higher, so they're buying, at lower prices now. So we really don't know how this is going to shake out. But the mere fact that so many consumers, as is reported in these, studies, are focused on tariffs. They know it's a potential problem. The sooner they get that problem out of the way, and we see actually how these things do flow through, if they do, the better we're going to be. You also passed around some comments. The Treasury Secretary thinks he can manipulate intermediate term rates, or maybe cause lower rates to go down, and they've stabilized. Interest rates dropped a little this week. That's a good thing. Mortgage rates have gone down, and that could enable consumers to spend more, perhaps, if they're confident on housing. We'll have to see what happens, but there are concerns. But there's so much money out there that I don't think the Fed's that concerned about, it's not out of control yet, whatever's going on. But tariffs are not within their control.
For sure, and I think the rate conversation is an interesting one, in that the Fed only controls those really short-term overnight rates. And actually, the Treasury Secretary, at least near-term, might have a little more control over what happens with a 5-year, a 10-year, the mortgage rates that are much more closely tied to those long-term rates, because they can choose, do I want to issue a 2-year bond right now or a 10-year bond right now? And we've seen some of the conversation shift to maybe the Fed isn't the piece that's going to be the focus for the next couple of years' conversation on inflation. Maybe they can kind of just leave things steady, and maybe we have to pay a little more attention to what's coming out of the Treasury now, because ultimately that's what they're trying to do, is keep those rates I think lower than where they might otherwise be, but not so low that we're encouraging bad habits now in another area. And so, I think the housing conversation is probably the biggest one for me. It's one of the kind of 2 or 3 areas where inflation remains a significant problem. Housing prices and the affordability of housing as a result of mortgage rates, a pretty big part of the conversation. Joel, on the economic front, beyond consumer sentiment, unemployment, we had some readings from ISM on manufacturing and services sector, some signs of expansion, which is encouraging in both of those indexes, although I think just like every other thing we're looking at right now, there is some mixed news out there.
Yeah, so the services index, which I already referred to, showed that the service industry was expanding for the 7th month in a row in January, although it was slower than it has been. And in the manufacturing side, that actually showed expansion for the first time in 26 months. So that's a good sign, and that's for the month of January. But we also had Commerce Department report on the December factory orders, and that was down for the 4th time in 5 months. If you take commercial aircraft out of there, that's that's a big factor. But it's still manufacturing sector isn't real strong right now.
And of course, I think that's part of what this administration has said they're trying to reinforce. The reality is that can take a pretty considerable length of time to try to build up that capacity. And so I'm not convinced that we're going to see those numbers drastically shift near term, but definitely a commitment.
We also saw numbers on the trade deficit, and that's something where the administration, at least the president in the past, has pinpointed that as a number that he'd like to turn around. And in 2024, it was the second largest trade deficit when you count goods and services in history. It was $968 trillion. I'm sorry, $1 billion. I saw trillion somewhere else on here. The record was over $1 trillion a couple of years before that. And the things I've been reading about it, there are mixed opinions from economists on what tariffs will do to the trade deficit, whether it's going to make that bigger or smaller, and how that's going to fit in there.
I think as long as consumers keep spending and a lot of the things we buy aren't coming from our country, well, there's only so much that tariffs are going to deter that spending near term, especially if those spending patterns are pretty well entrenched. But longer term, I think it does incentivize either manufacturing back here in the U.S. for certain things, or maybe consumers start to shift some of that spend towards other areas down the line. And so there can be some very direct impact on consumers. There can be some very direct impact on spend. I think some of that's the point. And then what we were talking about earlier, maybe some of it is, well, what we're saying and what are going to happen are going to be two very different things. And so we do, I think, need to listen. We do need to pay attention to what's being said. But at the end of the day, then we also got to follow along with now what's actually been implemented.
Again, it's that aspect of uncertainty. The FactSet reported this week, they listen in on all of the earnings calls from all of the companies, and the 62% of the S&P 500 that have reported so far, they've mentioned tariffs more than in any other earnings season since the end of 2019. So here we go.
Here we go. Well, I think plenty to keep an eye on over the weekend, plenty to pay attention to. If the Super Bowl indicator holds, then I guess we're all cheering for the Eagles. I'm not really going to put my nickel down one way or the other that it really matters at the end of the day. But, I think just hope that we get some clarity on some of the uncertainty that's out there. Hope that as we continue down these paths that we find ways to continue to protect investors in ways that are appropriate, that the rates that are out there right now make it a little easier than it was a few years ago. And as always, we enjoy doing the program for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.